for joining this webinar. This is the 19th KSB webinar. We are delighted to have Jahanzeb Naseer join us today from Hong Kong. He's one of the senior most finance practitioners from Pakistan globally. The remarkable thing about his career is that not only he has held very senior roles in investment banks, in investment analysis, and he has ran some of the largest research departments in Asia. He has also been on the buy side, and within that, he has been training research analysts at some. So with that background, Jahanzeb, delighted to have you. Thank you for taking your time for this webinar to talk to us today.
Thank you very much, Ali. Thank you. No, it's a pleasure to be here, and thank you very much for inviting me. And I'll just, before we kind of start, I need to give a disclaimer that any views that we discuss are my own. They don't represent any of the firms that I have worked with in the past or I'm working with right now. So with that out of the way, we can start our discussion. And again, thank you very much for inviting me, and thank you to the participants who've joined in and are giving their time to learn whatever we can share in this presentation.
It's absolutely our pleasure, and we are delighted to, looking forward to this discussion and learning from you, because clearly this is something which you do on a much wider scale. You train people to become good analysts. The recording of this video will be available on KSB's Varsity's website, where more than 1,500 students are currently enrolled and doing a program on investment. This video is, besides the people who are joining us on Zoom call, this is being live broadcasted by DBTV, and typically like 1,000 to 3,000 people watch it live as well. Now they're kicking off with the first question, which is of course the big one. Would love to get your views on the global market outlook, especially post-COVID. There seems to be a concern that equity prices have jumped up too quickly. Are we in a bubble? And as an analyst, when you look at this, how do you analyze a situation like this where there does seem to be some kind of disconnect between valuations?
Yeah, true. So it's a very wide question, and obviously it's a question that I would say in most cases is above most people's pay grade to call where the global markets are going to go. But I will try. It is so global markets. You have to see first of all what is it that the markets trade on, right? So first of all, if you look at the past 100 years, each market cycle tends to be different. So it's very difficult to say that the average bear market is 1.5 years and average bull market is 3 years. Every market, so averages can be very distorting. And I'll share you a couple of charts on that to show that. The second is that you have to see what do the market prices represent, right? So the market is a discounting mechanism. It is discounting future cash flows. And that is a combination of really three things. One is future growth. The second is the discount rate on which you're discounting. And the third is the risk premium that the market is willing to give, right? So those are the three things that will determine what the valuation of a market is at any point in time. Now, within that, growth is just one factor. And actually, in a lot of the bull markets historically is not the most important factor. So the reason there is a sticker shock on the market right now is because people are saying that there's no growth. And growth prospects future doesn't look that good. Why are the markets trading where they are trading? So on that, the question is that that's true. Markets, if you just purely markets were a discounting mechanism for growth, none of this makes sense. But it is not. There are two other very important factors that are at play, and that is why the markets are where they are. So to kind of answer your question in a direct way, I think volatility will continue to be high. So the next 6-7 months, we are getting into 2 or 3 areas which could potentially be headwinds. One is that from next week, we are starting the result season. So there will be some earnings reflection coming in over the past 1 quarter. So everybody is discounted the first half of this year. So there would be, that really hasn't mattered. People have looked through that valuation. What will matter is how the companies are starting to guide for next year and the year after. Just to give you an idea, almost 90% or above, if I recall correctly, of the companies stopped guiding in second quarter. So people are waiting to see whether some guidance comes back and they can start putting the numbers. So that is one area where there'll be some volatility coming in. The second part is that we are getting into an election cycle in November. And one of the key trends over the past 10 years has been global trade, improving global productivity, and falling tax rates. All three of this are probably going to be put on question as you go into the next election. So obviously trade, people already realize that we are post the world trade, open trade type of a scenario, and we are going into a world which is going to be much more inward looking. But the other key factor, which I think people haven't focused on this much, is that if actually Trump loses, what will be the tax implications for US economy? And roughly during Trump's tenure, 10% of earnings growth has come in from tax cuts. So if you assume that maybe half of that, and I'm just picking a number, half of that goes away, that's a 5% hit on earnings. So just on that, there should potentially be a 5% pullback if you assume everything else remains constant in an economics term, but obviously nothing else remains constant. But that's one headwind that will come in as you go into election. People will start worrying about taxes. So capital taxes will probably go up, corporate taxes will go up, personal taxes will go up, not all at once, but the trajectory of taxes is going to be higher, right? So that leads to this kind of probably level of uncertainty as we go into November. But broadly, I think looking for the next 2, 3, 4 years, I think markets, I'm pretty constructive on the markets for the same reason that essentially earnings growth is not there, but the other two factors are very much in play and are actually a lot more important than earnings in determining asset prices.
Thank you for that. And as you said that volatility might be higher in the short term given the uncertainties which you mentioned. What about if you look slightly longer term, so 5 to 10 year horizon? Do things like increase in debt and the dislocation in the market which has created because of COVID, does that worry you?
Yeah, I mean, it worries me, but also worry is really a good thing in the markets though, right? So if you are not worried, that's probably the point where you should be selling stuff. If a lot of people are worried, I mean, there's a very well-known saying that bull markets climb a wall of worry. So as long as people are very worried, and there's a lot of people talking about that, oh, markets are dislocated, markets are too high, that's not a bad thing, that's a good thing. Eventually what you see is towards the top of the market, very few people are questioning the valuations and questioning where the markets are. That right now, I mean, I looked at that number a couple of months ago, and above 90% of the investment newsletters were bearish, right? So that actually is a very good contrarian indicator. So when most of the market is bearish, there's an indicator that some of the famous investors use, they call magazine cover indicator. So when magazine covers are saying that markets are overvalued or markets are undervalued, that's a good contrarian indicator, because that probably means that that's the common sentiment and you should probably be betting against that. Let me show you a couple of charts that give you an interesting idea on that. So this will also kind of relate to a few things that we talked about just a little bit before that. So essentially what you're seeing is that this is going back to the 1950s, and these are various bull markets in green and the various bear markets in red. And what you essentially see is that there's no clear pattern. When you look at averages, yes, average return is 300% and average bull market is 72 months, but there have been 10-year bull markets, there have been 2-year bull markets, and the bear markets have varied a lot as well, right? So we are at this point now where, yes, it seemed like it was a very, very short bear market, but I mean, if that is the reality, then you have to take that as a reality and move on from there, right? Then the other point that you're talking about, that how does this growth kind of tie in with where the markets are? So if you look at this chart here on the left is essentially the overall nominal and real GDP growth through expansionary cycles. And this goes back to 1949. And what you saw was that since June 2009, which was the last bull market, if you look at for the last 10 years, this has been the slowest economic expansion in basically the past 80, 90 years, but the longest bull market in the last 100 years, right? So growth, yes, is one factor. It's very difficult to get bull markets if there's no growth, but having low growth doesn't mean that you can't have a very sustained and long-term bull market. The other thing to think about is that if this is the right-hand side chart is the total factor productivity in the US. So that basically tells you how productive the US economy is, and that links to the growth here. And productivity has been coming down a lot. So it's not the most productive decade. It's not the decade of the highest growth, but the markets did run up the most in 100 years, the longest bull market. So there are other factors at play clearly. And one of those factors probably is this, that if you look at GDP growth, money supply versus nominal GDP growth, money supply actually has gone up a lot faster than GDP growth. And that has actually resulted in asset price increases and has resulted in the household wealth gap with GDP. So as you put a lot of money, that has to go into either economic productivity, and if economic productivity is not increasing, then it'll go into asset prices, right? And that's really what has happened. So just one more chart. I'll kind of on that topic. I'll show you, and then kind of we can go on to any other questions that you have. But basically, if you look at markets right now, this is going back to '92. But I actually saw a chart that somebody sent me, which is obviously implied, but a 5,000-year chart of interest rates. And interest rates over the past and obviously when they have 5,000 years chart, they're probably not using 10-year treasuries, right? Just to make it clear. They're using some implied interest rate based on various barter transactions that were done in the prehistoric time, and then in the pharaoh's time, and then later on. But essentially, if you look at implied interest rates over the past 5,000 years, interest rates have never been this low. So this is not normal, right? So the thing is that we've only seen the past 10, 15 years in our financial careers. We think it's normal. Having negative interest rates is not normal. So you should not expect normal behavior from asset prices, right? And if you think of interest rates as a discounting mechanism, when interest rates are below zero for most of developed world and close to zero for US, that essentially means that you're discounting future cash flows at a very, very low rate. And that would mean that actually valuations would be very high. So it's just a mathematical reciprocal of interest rates. So having higher valuations is actually very normal in this environment. So if you get too fixated on valuations, you will not be able to analyze the markets in the environment that we are.
Well, thank you. This is very, very insightful, and we have had many webinars and discussion on this point. But I think the data which you showed is perhaps the given us the most clarity in terms of this question, which I suppose everybody is debating right now. So thank you for that. Jahanzeb, coming closer to you, you're based in Hong Kong, and China-US tension is a major theme which people think will impact the markets going forward. How do you see that impacting? How is that a big concern where you are based in Hong Kong? And how do you think it will impact Pakistan? Are there any opportunities you can think that Pakistan can exploit?
Yeah, so I think there are two questions here, right? First, what is the trade war? How does it impact markets? How does it impact growth? So we're clearly moving into a world where globalization is moving towards localization, right? And that would mean that a large part of global growth was driven by improved productivities, improved supply chains. People were producing in areas which had the lowest cost of production. And as a result, the profitabilities were better. If they have to relocate to higher cost of production areas just because they don't trust global supply chains, that would mean that profitability will be lower. That would also mean economic growth would be lower. So that clearly is an impact. And that's one of the reasons why forecast of global growth is going to be lower than it has been in the past. How much of that is reflected in the prices is really a very difficult question to ask, to answer actually. I think the near-term views on that is probably reflected in the prices. So if you look at global overall economic growth, is probably reflected. What is probably not reflected is how that is going to impact specific companies and specific sectors, because that is going to play out over the next 3, 4, 5 years. What will happen to tech supply chains? How does that affect Apple? How does that affect Intel? Would China have to build its own chips going forward? Will it have to just integrate all the technology locally? What would that mean for margins for various companies? That part will play out, and it's very difficult to predict right now. But one thing is quite clear, that we are moving into a world where you are separate. You're basically into an economic warfare. And I was just listening to something that somebody who has much higher insights than any of us, Ray Dalio, the other couple of days ago, and he said that actually, if you look at each of the big conflicts in the world, 10 years before that, you saw economic conflicts. So economic war started. If you look at World War II, World War I, if you look at before that, the wars in the 17th century, before even the US independence, 10, 15 years ago, before that, economic wars had started. So if you look at US history, before the War of Independence, there was the Boston Tea Party. They were burning stuff. They're putting ships into the sea full of tea, and that's where the name comes from. So we are in the first innings of probably an economic warfare. So that probably is going to go on for 8, 10 years. But that is something that one has to kind of build into our valuation, and the risk. So volatility as a result will be higher. So that's the first part of it. I can't give you a clear answer on whether it's pricing or not, but I think that's the risk that you have to think about. The second part of how that affects Pakistan will depend quite a lot on how Pakistan plays it, to be honest. I think Pakistan so far has kind of clearly aligned itself with China without actually burning the bridges with the US, which probably is absolutely the right policy to use. Going forward, let's say 3, 4 years down the road, it may not have that choice. It might have to pick a side because it just happens to be geographically in an area where it's very hard. If the conflict continues to, let's say, expand, it'll be very hard for it to basically stay neutral. And increasingly, it seems that it is siding with China. And that is where probably most of the capital flows in the country are coming in. There could be an opportunity to gain from some of the supply chain disruptions that are happening in China, because Pakistan could take advantage of that, especially in low-end labor-intensive industries. So I think broadly it could be positive for Pakistan. Our trade dependence on US is actually not as high. We do a lot more trade with Europe. But what we need to do is we need to expand our trade within Asia. So hopefully that is something that kind of pans out. But early stages to say, one of the key things for Pakistan is that it cannot, as it stands right now, take over some of the higher value-added supply chains from China, which is really where the big opportunity is. And Vietnam and Cambodia are doing a lot of that. But other than that, I think it can benefit from it, especially from the incoming investments from China.
Jahanzeb, a few years ago, there used to be a lot of enthusiasm for Belt and Road, and it was visible. When I visited Hong Kong, it was very visible there. You saw ads and posters of Belt and Road project. How's the sentiment there now on it? Are Chinese still actively thinking and talking about Belt and Road and expanding on that?
So I think it's taken a little bit of a backseat. And I think the reason for that is that there are more important things on the agenda right now, at least as far as the headline news is concerned. So headline news is a lot more focused on China, what the rules are doing in Hong Kong. It is also kind of very dependent on and very focused on what is happening between China and the US. So when you look at all of that stuff, it is clear why Belt and Road and FDI is not the center focus for press and media anymore. But if you look at what is actually happening on the ground and in terms of numbers, there is no pullback in or decrease in intensity in China's FDI, in China's kind of loans to different countries, their investment in projects. So I think it's not headline news, but and normally when these things start, they become headline news. And when the operational stuff, boring stuff starts happening, they're not that newsworthy. So now we are in the boring phase where actual investment is taking place. They're building infrastructure. So it's not in the news, but it is very much going on. And I think China now realizes even more than before that that's a very important part of its broader strategy in the region, that it needs to basically build economic ties within Asia. And Pakistan will be a key focus of that. So I think that part is going on despite it not being top of the news.
No, thank you for that insight. You mentioned Vietnam and Cambodia, and that supply chain is shifting from China to some of these countries. And a few days earlier, I was looking at the numbers for India, and the Chinese investment into India, even in the tech sector, has been much larger than the investment into Pakistan. Do you think that, is there any press coverage or any chatter on the street, at least in the financial sector, about the recent India-China clash? Or is that not a news for the financial market?
Sorry, I'm just putting in my charging wire to the phone to make sure that I don't run out of battery. So just give me a second on that.
Sure, please take your time. It happened to me.
Yeah. So, yeah, just a second. Let me see if I can put it somewhere. Sorry.
No problem.
Okay, can you guys still see me?
Yes, we can.
Yeah, okay. It's on the landscape mode now, so okay. Okay. So I think actually in the Hong Kong press, surprisingly, there's been quite a lot of coverage of that. I'm not a defense expert, so I won't kind of give any judgment on what that conflict means or anything, but there has been quite a lot of coverage in Hong Kong press, surprisingly. And they're also talking about how Pakistan could be a strategic factor within that. But I think it's very kind of superficial type coverage. The broader things, what are happening on the ground and all that is actually, I don't think anybody really knows. What you see is what you see from both the India media and the Chinese media. Here, obviously, we see a lot more of what the China media is saying. But really, it's not my area of expertise, so I'd rather not comment on that.
Sure. As you said, what I was more interested is in the financial markets have people started commenting on it, or more not from a political perspective, but more in terms of the investments which Chinese have done in tech sector, and post the ban on TikTok. I wonder whether any of those investments would now move to Pakistan or would need to find other home just because there's one market from where they're being pushed.
I mean, again, I would what I would say is that I don't have any kind of serious insight into that, but I mean the obvious thing is that if certain Chinese apps are being banned in India, it is quite obvious that they would be looking for alternative markets. But also what it tells you is that India has that leverage, right? It is one of the biggest potential consumer markets. And if there is a conflict with China, India has that ability to retaliate and be able to block some of their technology, which China probably doesn't want at a point where US is blocking a lot of its technology. It doesn't want the second biggest market in the world to. So that tells you that hopefully, and as a result, there will be probably logical discussion around that, and that could be one of the things which means that the conflict doesn't really escalate. But I think because they're also very prudent, they would be looking at other markets, but it's not like they were not looking at other markets before. So they already have a lot of JVs in Indonesia. They probably have, actually they have some JVs in Pakistan. Obviously the Pakistan internet and tech market is not as big, it's quite small. So the size of those JVs is relatively smaller, but I think they would be looking at other options, but there's really no other market in Asia that if you close India, that will make up for the difference, right? So that is a key strategic market, which probably means that they don't probably want the conflict to escalate.
So you're spot on that trade and economic ties are very powerful, and they have proven to lead to peace and stability in the world. So thank you for highlighting that. Jahanzeb, moving closer to Pakistan, you have invested and analyzed many markets in the region. Pakistan has always tended to trade at a discount to regional markets, and the magnitude of this discount has varied. What do you think Pakistan can do to reduce this gap which it has even with other regional markets?
Yeah. So again, I think if you just go back to basics and break it down on why markets trade at a premium or a discount to each other, right? So there are three factors in that, which is one, again, like I said before, one is the growth differentials. So markets that have higher growth tend to trade at a premium. The second factor is your risk perception, that markets where investors have risk perception, and that's why I'm using the word perception. Actual risk and risk perception can be two different things, but markets that have higher risk perception, people will want a higher return from those markets, and as a result, it means that these markets will probably trade at a discount to the other markets. And the third factor is the what you call the discount rate of the market. So there's basically what is the level of interest rates in one market versus the other. So if you think about each of these components, there's certain things that the companies and the government can do on all three components to reduce the discount rate. There is no way to just say, okay, we want to reduce the discount rate without handling these three elements for it, right? So the first part, if you look at growth, everybody knows that the government wants growth. They want to incentivize growth industries. So that is one part that obviously it's not very controllable. A lot of governments think that they can control growth, but really growth is end product of some of the other things that the government does, which is having stable policies, having less interference in businesses, creating an environment where investment comes in, and also creating an environment where it's conducive for people to basically be entrepreneurs and create businesses, right? So that is the growth part. And if they do that, then growth will come as a result of that. The biggest thing that the government can do to reduce the risk perception and as a result, the discount rate versus other markets, to have consistency in policies. The worst thing that the government can do is have one policy one day and change into another policy 3 months later, and another policy 2 years later, because that people have to then build into what they're paying for the companies. Because if I'm paying for certain stream of cash flows today, and I think that my level of certainty that these cash flows will be sustained is only 50%, I'm going to pay a much lower valuation. Versus if a company, I know, okay, it has a contract with the government, and as a result, these revenues are coming in, and I'm 80% certain that those policies are not changed, I'll pay a much higher premium for that. So that is one thing, that the government having the right policy is not that important, to be honest, in my view, as far as discount rates are concerned. But having consistent policies is very important. So that's one element of it. And the third is to bringing the interest rates down. And for that, you need to control inflation. You need to control your deficits. And this government is trying to do a lot of that. So hopefully rates will come down. But the other two elements will be very critical to bring the discount rate down. There's no shortcut to that. And I think historically, what various governments have done, so much flip-flopping on policies has not helped in kind of removing Pakistan's discount rate. I mean, if I have to mention one thing, is particularly the shutting down of the stock market in 2008 didn't help, when it got Pakistan kicked out of the emerging markets index. And now we are kind of struggling to keep our place in the frontiers market index, right? So those kind of things don't help.
Yes, no, absolutely. I love it, the way how you break things down into components and then you analyze it. So, thank you for that. We will open up for Q&A in 10 minutes. And before that, I can sneak in another question. Globally, which are the markets which you like, and which are the sectors which you think are attractive?
Yeah, actually, I have a chart that might not directly linked to that, but maybe kind of help us in a few things on that. You didn't ask me a question on that, but this is an interesting chart that I'll talk about just in any case, because I think it's something that is quite insightful in terms of what is happening politically in the US, and it tells you that actually we've seen this happen before in 1925, 29, 30s, and we are at that point. So these conflicts that you see politically are not always political conflicts; they have economic underpinnings, and we can talk about that briefly. But there's another chart that I think I wanted to talk about, which is, yeah. So I mean, this is one thing that's quite interesting in terms of you saying what markets and what sectors could be interesting. One other way of looking at things is that what kind of factors, underlying factors in the market could be interesting. So this is essentially value versus growth performance. So what this tells you is that you had this world, which from basically 1974 to about 2000 was a mean reverting world, that basically value used to outperform for a few years, then growth used to outperform for a few years, and there was a mean reverting cycle, which basically created a lot of value investors, and people knew that, okay, if you bought value at these points where things were really cheap, you will make a lot of money going forward. Again, this was a big dot-com bust, and after that, value did outperform, and again, got people into a lot of value stocks at this point, but value hasn't really worked well from this point onwards. And one reason, so that one way to think about is that probably looking at good value stocks at this point could be interesting, because if people are looking at putting more risk in the market at some point in time, they would be looking at things that are perhaps cheaper than other sectors. If you look at, I don't know if I have that chart or not, but I think, yeah, I don't have that chart, but if you look at basically the US market, the top 5% of the companies are at an all-time high. But if you look at the companies that are actually COVID affected, like retail and entertainment and all that, they're still 50%, 60% below their high. So there are two markets there. And then depending on your view, if you think things are going to normalize, I would think that there is an argument to be made for rotation out of the leaders into sectors that will start normalizing eventually as COVID cases come under control and as things normalize for regular industries. There's one more thing that probably I want to point out, which is that this is a chart of global industrial production. So it's a very simple chart. This is somebody that I follow in the markets who basically produces this chart. And this actually is just, as I said, just to repeat, this is just industrial production, simple industrial production over the past 40, 50 years. Industrial production falls in recessions and then gradually climbs back up. The fall that you've seen in industrial production here is the highest that you've seen in probably since the Great Depression. And we are starting to see it normalizing. This is the forecast. So we are starting the forecasted to kind of still be below 1 standard deviation at this point. And the reason this is important is that if you plot global IP momentum, which is basically industrial production, global industrial production versus world MSCI index, it tends to track it very, very closely. That's why it's important. Otherwise, it's not an important number. And what you're seeing is that if there's going to be this rebound in industrial production that we're talking about here, then it's very likely that the markets, and that's what's happening right now, that the markets are discounting that rebound in global industrial production. And I believe that as a result, as right now, everybody is focused on Zoom and Microsoft and Facebook and Amazon, which are basically the big beneficiaries of the COVID dislocation. But as things normalize, I think industrial sectors and cyclical sectors will probably do quite well, and there'll be a rotation from those kind of tech-heavy sectors into the like more industrial sectors.
Thank you, Jahanzeb. And before we go into questions, would love to see that chart, the point which you wanted to make about income distribution.
Oh yes, okay, yeah. Let me share that with you. So yeah, that's an interesting chart here. So this is so right now everybody's talking about that how the 1% versus 99%, right? That you have 1% of the population that's controlling all this money, and how much wealth is being concentrated on certain segments of the society. And actually, this is very similar to how the US economy was in 1929, 1933. And regardless of the other economic indications of that, that led to a cycle over the next 10, 15 years, where first that wealth gap fell quite a lot. And the reason it fell basically was for two reasons. One, taxation went up. So and then the politics moved from being a very kind of liberal capitalist type society to much more of a controlled and government driven society. If you, I think there was a point here in 1960s when it bottomed, where the marginal tax rate in the US went up to 90%. So a lot of us don't know that, but it was 90%. So you could see taxes going up, and that's one of the risks that I talked about earlier. But we have seen this episode before. So one of the advantages of the financial markets, and why I think it's such a fascinating field, is because you have so much things that you can learn from history and see how things panned out over the past 100 years, 200 years, and then see what lessons you can learn from that. And what this tells me is that this is and economic policies that followed here are probably going to be similar to economic policies that follow here, which means that taxation is going to go up, and you will have a lot more state control in businesses than you've had in the past 20, 30 years.
Wow. Now, so on the same point, Jahanzeb, of course, you train analysts, and a lot of students and analysts are on this call from Pakistan. What will be your advice to them? How can they become better analysts?
Yeah, it's a very broad question, but I think my first advice would be that to be a good analyst, you have to be very inquisitive, right? So an analyst job in a way is a combination of three jobs. One is that you have to be journalist, you have to be an accountant, and you have to be a private detective, right? So if you put those three things together, then you are probably a good analyst, right? So you, as a journalist, you need to know how the history worked, how various parts of the economy work. And as an accountant, because at the end of the day, you're analyzing companies, and companies' books are written in the language of accounting, you have to understand how accounting works. And private detective, in the sense that if you don't do this third part of private detection, then you're basically just reporting what's going on. What you need to do is go one step forward and find out, okay, how is this thing working? What is the market not understanding? What can I contribute to, say, analyze this situation? And each person will have their own edge in that, right? So then I've trained so many and worked with so many good analysts in my career, and not two of them are good in the same way. Every analyst is good in a different way, right? And the analysts tend to figure that out over the course of the first 5-10 years in the industry, that what they're really good at. And that's the third element that will make them good at it. But the bottom line, again, if you kind of underline all of this, is that you have to be interested in markets. If you're not interested in markets, if it doesn't excite you, if you don't want to kind of find out how things happened like in the past, how these companies can make money, how businesses actually work, then you will not be a good analyst. I mean, I still get excited about looking at businesses and looking at companies, and I think that is part of the interest, because you could be a reasonable analyst, but to be a good analyst, like any other job, if you're not kind of passionate about the job that you're doing, you will never be very good at it. So don't go into the industry just thinking that, okay, you get paid more, because to be honest, as the best analysts get paid quite a lot, the average analyst probably gets paid the same that as average employee in a pharma company or another multinational gets paid after 10, 15 years. So yes, your starting salary might be higher, but if you're not going to be the top 5-10% of the analysts, your total NPV is not very different. And to be the top 5-10%, you have to be passionate about it. If you're not, you will not be the top 10-5%.
No, thank you for bringing that, because I totally agree with you and appreciate your views. Because I think in Pakistan, what I see is that people are really good and focus on the accounting part a bit too much, and they forget the other two parts, which you mentioned. understanding the historical context and also then looking at the future and trying to see the mispricing. And I think that part of finding the mispricing and questioning where the market has got something wrong, I find that underappreciated in Pakistan. There's a lot of focus on getting the template right on accounts, or in terms of the valuation models and all that stuff. So thank you for bringing that. We're moving to Q&A. As like with other webinars, the format for questions is that please, if you have a question, put it down on chat and then I'll read it to Jahanzeb. We already have a few questions. So starting with the first, I saw a question from Junaid Iqbal. And how long do you think such low interest rates could prevail?
Globally, you mean? I mean, obviously Pakistan interest rates are still high. So I assume Junaid is, and hi Junaid, how are you? Junaid has been, if I recall correctly, had been in the broking business. So he kind of understands some of this stuff as well before he became like an entrepreneur and started running what he's doing now. So I am of the view, and I think a lot of kind of very senior market analysts and investors believe that interest rate will stay low for the rest of our lives. So I think it's a very long-term cycle. And there are couple of reasons for that. One is that it is like the term that people use, that you're riding a tiger, right? You can't get off. So the level of debts have gone to a level where you cannot afford to raise interest rates. If you raise interest rates, the debt burden, interest burden in the societies goes up, where it becomes unsustainable. Second is that what central banks are discovering is that actually their ability to keep funding and keep liquidating and keep putting money into the market is almost unlimited. And if you look at various economies, so I mean, US, if I recall, and I don't hold me to this number, I might be wrong. It's about, I think above 100% of GDP is the balance sheet of the Fed now. If you look at Japan, it's more than 200%. Japanese yen hasn't depreciated over the past 15 years, when the balance sheet of Bank of Japan has gone up from 50% to 200% of GDP. Yen is actually appreciated. So it kind of flips that theory on its head, that as you put a lot of money into the economy, currencies have to depreciate. There are a lot of other mechanisms that central banks use. And there's also, if the economy doesn't have a lot of external debt, if a lot of your debt is internal, you can actually, there's hardly a limit to where you can take debt to. Now, theoretically, in reality, there will be a limit. What it will be, we don't know yet, because no economy has busted to a point where we say, okay, this is the level where economies see a bust when a debt goes to that level. So, I mean, if you think about it, at 0% interest rates, whether the debt is 100% of GDP or 200% of GDP, your interest burden is the same. It's zero, right? So, yeah, I mean, so theoretically, there's no limit to it. So, I mean, I don't think interest rates are going up anytime soon. People kind of have said that, people who are more senior to us have said in their lifetime. So I'm assuming at least 10 years.
Yes, so lower for longer. Certainly, you know, we had that debate internally at our home when we were remortgaging our house. So whether to move to a floating or a fixed. And certainly, as you mentioned, even with, you know, the old aging population, you know, the fear of inflation is much lesser now than it was previously.
Yeah.
Moving to the next question, there's a question from Danish. He's asking that, do you think the US stock market could move down strongly if COVID cases get out of hand?
Yeah, I mean, first of all, COVID cases are out of hand, right? In the US, the number of cases that you're reporting every day are higher than the previous day. And it's basically, it's not like they're lower, they're at the highest level now than they were when we thought that they had peaked. So the market hasn't really reacted to that. So I think the market didn't really react to COVID, the market reacted to the lockdown. So I think it's very inconceivable that the US will go back to a national lockdown again. I think what will happen is that there will be localized lockdowns. and there will be kind of mandated restrictions in terms of on selective sectors like perhaps restaurants and bars and pubs and all that. But as long as we don't go back to generalized lockdown, I think the market will not react to COVID cases as much. The second thing that to keep in mind is that while COVID cases have gone up a lot, for the US as well, what you've seen is actually the death rate has continued to fall quite substantially over the past 2 months. So the severity of the disease seems to be decreasing quite a lot, and partly it could be that I think most vulnerable people probably got killed in the first wave, and now it's going to younger people, or whatever the reason is. Maybe the virus is less virulent now than it was before. But what you're seeing is that the death rate is a lot lower, which probably means that the burden on hospitals is more manageable. So if that continues to be the case, I mean, with the caveat that that continues to be the case, I don't think that the market is that focused on that number anymore.
No, totally agree. And we have seen that in UK as well, that the cases are increasing, but the government is now actively trying to get people back to work and back on the road. In fact, the government is thinking about giving people vouchers so that they go out and spend it. So yeah, despite having 1,000 cases per day and despite having more than 100 deaths per day. So I think the lockdown thinking is gone. There's another very interesting question. And this was a big issue prior to COVID, which is regulation on tech. Do you think that this will come back again with elections coming, and do you think it will impact valuations in the tech sector?
I mean, I'm not an expert in that sector, either on tech or on regulation, but just broadly, I think things are going to be a lot more regulated generally. I think as again, if you go back to the point in the 30s when 1% of the population had 50-60% of the wealth, that followed a period of 10-15 years where there was a lot more regulation on businesses, taxes went up, government deficit went up, government's involvement in businesses went up, and we're already seeing early signs of that, right? So you're seeing the government funding unemployment a lot more aggressively. So if you think about in your personal life, people that you are helping financially, you get a lot more involved in their decisions, right? So if the government is helping auto companies, airlines, banks, individuals, restaurants, and they end up owning part of that, there's no way they're going to let them do whatever they want. They will be more involved in their life and their decisions. So I think generally regulation is going to go up because it goes with financial ownership. And the government is now owning a lot of small and mid-cap businesses, not only big businesses. They've given, maybe not in equity, but they've given wage subsidies to a lot of businesses. So they have a financial interest in these businesses, and they will dictate the terms to these businesses. Tech is going to be no exception to that. I think, and partly tech will probably be a more focus on that because that wealth concentration is largely driven by the tech cycle over the past 10 years. So there will be a focus on that. And there's a risk that tech valuations could come under pressure on that. I mean, there's no evidence for me to say that that's going to happen and when that's going to happen. But there's clearly a risk that could happen.
Very interesting. And linked with that, there's a question that do you think a Biden victory will change the relationship with China?
So, I mean, you're saying Biden victory, you clearly believe that that's going to happen. I don't know. It's hard to say. Again, I mean, I'm not, again, I would qualify that I'm not a political expert, and these things are so difficult to call that who's going to win. I mean, these things can change. There's a lot of time still, so these things can change a lot. But it clearly seems from the debates that I've heard during the campaigning that actually the China factor is very similar between the Trump and whichever administrations come in. No one during the Democratic debates came out to say that, oh, we need to open up to China and the China policy is wrong, because just the broader sentiment has become a lot more insular. And as a result, there is no political mileage to be had from saying that, oh, we want to go easy on China. And so in actual policy might be different, but I think going into the election, the rhetoric is probably not going to be very different.
I agree. I think it's bipartisan support for the Chinese policy, and if anything, I think Trump might be a better pro-business person than anybody else. Moving on, there's a question that the forecast, I think, out by Goldman regarding the US dollar. I'm not aware of that forecast, but I'll just ask you a broader question. Do you have any opinion on the US dollar? I think there are some concerns about.
Sorry, what forecast is that?
So it says, do you agree with Goldman's prediction of USD 100? So I am not aware of that forecast, but I'm broadly, I think, do you have any comments on
that? I'm not aware of the forecast. I mean, the two things that I've learned that you should never try to forecast, one is oil and the other is currencies, because that's the best way to get burnt and lose credibility is try to forecast oil price and just try to forecast where currencies are going to go. So I don't have a view on that. I mean, going by what I've seen in Japan, just large amount of monetization doesn't mean large amount of currency depreciation. The other thing to keep in mind is that currencies are a relative exchange rate, right? So it's not an absolute exchange rate. Dollar's value is relative to some other currency that you're talking about, right? There's no absolute dollar value. And if everybody in the world is doing financial easing and quantitative easing, then the relative value will not change, but the relative value to currencies will not change, but relative value to assets will change, which is another way of saying that asset prices will go up, which is another way of saying that probably the markets will do well. So exchange rate versus other currencies probably doesn't change, but exchange rate versus real assets will probably decline. I mean, that's the limit of my kind of insight that I can give you on currencies, but nothing probably more than that.
No, absolutely. I think that's very wise. There are a few other questions but I think that you have already answered some of those which are on the market in terms of why the US market has gone up so much, and I think we discussed that earlier. And the recording of your webinar will be available online, so we can go back to that. There's a question from Akbar Latif, which is, how important is developing a personal valuation philosophy? And to become a good analyst, which subjects, apart from account or finance, should one study?
So on the first part, I think personal valuation philosophy is a very broad term. What I kind of tell people, especially investors, is that you should have a process. And valuation will be one part of that process. But you have to have some kind of a process and the reason for that is that your investment should be a repeatable exercise, right? That you should be able to see over time that if you do these three things, your investment decisions turn out to be right. And when you don't do these three things, your investment decisions turn out to be wrong. If it is not a repeatable process, then you're not an investor, then you're a speculator. Because sometimes you'll be right, sometimes you'll be wrong. It could be timing, it could be a lot of other things. But all successful investors, just like any other business. So, I mean, investment is no different from any other business. If you start producing automobiles, you don't go one day and start putting things together one way, and then next day go and start putting things together another way, assuming that you'll produce an equally good car every day. Every business in the world has a process, right? So investment is no different. So you have to develop a process that, okay, I'm going to analyze macro, then I'm going to analyze the company, and then I'm going to look at valuations, and then I'm not going to be swayed by where the market is every second day. And that's just one example, right? There are thousands of ways of coming up with a process, but it's important to have a process because every business, again, I repeat that every business in the world has a process. So how can you, and if you think of investment that you're doing your investment, you could basically use that money to set up a shop where you would have a process and you would probably make some money. Or you can use that money to do an investment, which is, again, you should think of it as a business. And if you think of it as a business, then it should be a process-driven business. And as long as you do that, you will make less mistakes. I'm not saying you won't make mistakes, but you'll make less mistakes. And valuation philosophy or your valuation framework is just one part of it.
And any interesting book or subject which you think an analyst should study?
Yeah, I think so. Subject, I'm not so kind of keen on. I think investment is such a broad phase that anything that you study is probably going to be useful somewhere. So if you studied biology, that will be useful somewhere. If you studied astrophysics, that'll be useful somewhere. So subject, study whatever you want. But I think study history is very important, especially financial history. So look at, I mean, the good thing is that everything has happened somewhere in the past in some form, not exactly this form, but in some form it's happened in the past, so you can learn from it. Quantitative easing has happened in the past, currency depreciation has happened in the past, uh, recessions, recoveries, all of that has happened in the past. Tech cycles have happened in the past. So there's nothing that is really happening that you can't learn from history. So I think one is that read books on financial history, on how things changed financially. And the second is just probably see which investors' philosophy and process resonates with you, and then follow their thinking and their process. Because again, again, I would use the same example that when you set up a business, 99% of the time you are copying somebody else's business idea, right? There are maybe 1% of business that do something that nobody's ever done before. If you're that 1%, great, best of luck, then you don't need advice from me. But if you're the other 99%, do what you would do in another business. You would probably think, okay, this business really works well in the US or India or Sri Lanka, and I'm going to copy it in Pakistan. Think the same way for investment, that, okay, this person has had a really good track record. Let's find out what he did or she did. And then you say, okay, no, that doesn't really work for me. Then you look at somebody else's process. So follow people that you kind of resonate with and develop your process from there.
Maybe I can ask a personal question. Who do you follow? You mentioned you quoted Ray Dalio earlier, and of course, you work with a legend in a firm which is run by a legendary investor. Whose investment philosophy has inspired you?
Yeah, I mean, the person whose investment philosophy has inspired me is the same person who's probably inspired everybody else, and his philosophy hasn't worked well in the past 10 years. So my PA portfolio is probably a reflection of that. So I follow Warren Buffett quite a lot, closely, from in terms of how he analyzes companies, because it's a very simple process. It's a repeatable process. Anybody can learn it, and it's not complicated. And it has proven to be a good process, and it delivers results. I've also, so from a macro point of view, but again, Warren Buffett doesn't do macro. So for macro, I would follow actually some macro writers who are not, so some of the charts that I showed you from some of the macro writers that I follow, and their attribution is at the bottom of that. So those are some of the people that I follow on the macro front. But again, Ray Dalio and these guys like Principles, all that, I mean, these are common sense stuff that he's put in a very eloquent way. And those things, I think anybody would learn from following those things.
Thank you. Jahanzeb, the last question, it's from Endo Takashi. It's a long question, and he has thanked you for the presentation. If I summarize his question, what are the risks you see in the market?
So, I mean, there are always risks in the market, right? So and it's the same risks. It's the question of whether that risks are high or those risks are low. So risks in the market are never, I wouldn't say never, because that's the wrong word to use, but are usually the same risks, right? So first risk is that that you lose money. I think that the only risk actually in the market is that you lose money. So then you have to see which are the ways that you could lose money, and that then starts quantifying your risk. I think right now, the way you lose money is probably getting either your call on quantitative easing wrong. So you've kind of misjudged Fed's willingness to go in and keep pumping money every time the market wavers, because that's a very strong underpinning of where the valuations are right now. And I showed you those trends and stuff. So if that call is wrong, then clearly then the call on the markets will be wrong. I think that's one big risk. The other key risk, which we are discounting right now, is that sooner or later this COVID situation will be resolved. If it is with us for another, let's say, couple of years, then some of the businesses that I talked about that have been severely dislocated and haven't really come back and still 50% below could potentially go bankrupt. Because if people can't go out and can't eat out and have to kind of change the lifestyle, that's the other risk. And then the third risk is of potentially conflict escalating from various things that we talked about earlier. But of these three risks, I think the Fed policy risk is probably the biggest.
No, thank you. That's very clear. And we have run out of time, but perhaps just one last question, and it's again from Junaid Iqbal, because you mentioned Warren Buffett and value investment, low interest rates and Fed policy. Is there any conflict between value investing and there is a conflict between value investing and with low interest rates? So how do we merge the two from an investment perspective right now?
Yeah. So, okay. So, I mean, I don't think there's a conflict. Okay. The reason being that if you read Warren Buffett's newsletter every year, his kind of comments on his annual report, I mean, he gives his process of valuing stocks, and he never says that he's a value investor, right? He says that he always tries to measure the intrinsic value of the business and tries to pay below that, right? So the question is, what is the intrinsic value? So if interest rates are low, your intrinsic value will be very high. And I'll give you a very simple example that when rates go from 2% to 0%, what do you think should happen to equity risk premiums? So equity risk premiums over the past 100 years have been 5%. Now, 5% is not a sacrosanct number. That was 5% because bond yields on average were about 8%. So 60% of that roughly was what you wanted in addition to for taking the equity risk. So is 5% more important or the 60% premium more important? So if you assume that it's the 60% premium, then on 1% 10-year bond yield, then the equity risk premium should be 60 basis points, right? So now let's say even if it's not 60 basis points, but it's 2%, then if equity risk premiums come from 5% to 2%, then the average fee in the market should be 45 times or 50 times. Now, that is a sticker shock, but actually you've had 50 times market, or at least certain sectors, 50 times PE, a lot more times in history than you've had zero interest rates. So actually, if you look at the zero interest rates, that's a much bigger anomaly historically than high valuations. High valuations occur all the time. Zero interest rates have never occurred in human history. So in that sense, valuations can be very high and you could still be a value investor because you're discounting future cash flows at 0% or 1%. And then you say the intrinsic value of this business is X and I'm going to pay certain percentage below X.
No, thank you. I think that you're totally spot on, that mentally accepting the fact that we are at zero interest rate or negative interest rate is a very difficult thing. And I suspect that's the issue which everybody is grappling on, that although we are aware of it, but just the framework we are used to don't allow that construct. So we keep on going back to the growth and the earning part, with something which we have always been trained to look at, and we forget this very important point, and the markets are not forgetting that. Thank you so much for your time, Jahanzeb. This was extremely insightful. It was a global, we had a global audience, and I'm conscious that now it's dinner time for you. It's lunchtime for me here in London, and it's time to go home for a lot of people in Pakistan. I learned a lot.
No, go ahead. Sorry.
Thank you. And I learned a lot from this. The recording of this webinar will be available on our website, kasb.blog, and also on the Varsity. Jahanzeb, thank you so much for taking the time for this.
Thank you much. Thank you, Ali, for inviting me. And thank you, everybody who joined and asked all the questions. Hopefully it helped you. I helped you answer some of the questions. But again, I'll tell you just in the end as well that take all these views as my personal views. They're not reflective of any company that I have historically worked for or I'm working for right now. And all of you, I'm very happy to engage with you. Let me know if you have questions. I'm there on LinkedIn. You can ping me on that. And always happy to kind of have a chat on markets and assets and where things are going.
No, thank you. And it is inspirational for us to talk to you and to see people like you do so well in the world of financial markets. So thank you on a personal note as well. So inspiring us.
Thank you very much. Thank you. I appreciate that.
Thank you. Bye bye.
Bye bye.